Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, this is the last Midweek Market show for 2 weeks as I take a small break over the Easter period. But to start this week's show, it's worth highlighting a few key points that I raised in last week's show, which included that in the coming weeks, we will find out whether the bond breakouts and the equity market breakouts. So when I talk about the bond market ones, in particular bond yields are breaking higher, we will see whether these trends are going to hold. Now, the equity markets will soon have to also navigate another corporate earnings season, which will include the impact of the war in Ukraine on corporate profits. That's a potential headwind on the S&P 500. I pointed out the 4,500 level remained an important level for the index to remain above if the rebound is to continue, and its 200-day moving average sits just below that level. And I also pointed out that the DAX in Germany, the equivalent support level was the 14,500 level. And if we were looking at bonds, and in particular the 10-year US Treasury yield, 2.22% was a level that was important, because if the 10-year US Treasury yield drops back below that, then it could mean that we would be back in that multi-decade downtrend in bond yields, and it would likely resume again as it did in 2019 when we saw a similar rally in bond yields. And don't forget, when bond yields rally, it means that bonds themselves, the price falls. That means your bond funds start to fall in value. And then finally, I noted that the volatility in bond markets had picked up significantly, while at the same time the S&P 500's VIX had tumbled back below its long-term average of 20. And that in itself is unusual. And historically, we often see equity market volatility pick up in response to a pickup in bond market volatility. And of course, if we saw that happen, then that would be bad for US equity markets, which in turn is bad for global equity markets. And of course, all of these things remain in play, or they came to fruition to a certain point at least over the last 7 days. Now, if we take that last one I mentioned as an example, now on Wednesday, the VIX broke higher, up from 19 to 24 after a hawkish soundbite, or a number of hawkish soundbites, in fact, from US Federal Reserve officials. And the market had remained previously steadfast in its belief that the Fed and other key central banks would not raise interest rates as fast as they had previously feared, or they would be forced to begin cutting interest rates again once economic growth faltered. But on Wednesday, the release of the minutes from March's Fed meeting suggested that the central bank would in fact raise interest rates and unwind its QE program more aggressively than the market had thought. Now, this finally gave the market pause for thought, and the S&P 500 closed the day below 4,500 to sit near its 200-day moving average. And don't forget, that's closely watched. It's at 4,490 at the moment, and normally being below the 200-day moving average is seen as a bearish sign, which could potentially highlight a potential for the market to fall further, but it's not a guarantee. But to the upside, the market now needs to break back above that 4,500 level and then move on to 4,600 if we're going to get that upside momentum again and head back towards those all-time highs and put the latest equity market pullback behind us. Now, it didn't help that on the same day, Deutsche Bank became the first major investment bank to state that it now actually anticipates a US recession next year. And not only that, but it also expects equity markets to fall by 20% by next summer, while they expect the 10-year US Treasury yield to hit 3.3% this year. So the upshot is bad news for bonds and bad news for equity markets in the future. Meanwhile, over in Europe, the German DAX tumbled as fears that the European Central Bank would hike rates aggressively, going up by 1.8% in just 18 months, which would be actually the fastest rate hiking cycle since 2009 in the aftermath of the financial crisis. And it all meant that the DAX in Germany crashed below that 14,500 level that I mentioned and now sits around 14,200, and it's down about 3.8% since the start of this week. And the 14,500 level remains an important one to keep an eye on over the coming weeks. So does all this mean that we've seen the European and US equity markets rebound and that then falter and it's really over and we're heading to new lows? Well, not necessarily, but it does complicate things slightly. And it does mean that we need to see both markets turn around pretty swiftly if we are going to regain that upside momentum. If we look at the UK, the FTSE 100 remains pretty strong and it's in its uptrend that started back in November 2020. And it currently sits at 7,583 as I make this show, but we really want to see it break decisively back above 7,600 and then that February high of 7,672 if we are going to revisit that all-time high of 7,877, which we saw way back in 2018. Meanwhile, bonds continue their dire start to 2022, and by way of example, if you look at the 10-year US Treasury yield, it hit 2.641% this week, which obviously means that the 10-year US Treasury tumbled, and that is really reflective of what's going on in bond markets more generally. And that 10-year US Treasury yield is at its highest level in 3 years in response to those Fed rate hike fears. And so the upshot is that bond and equity markets remain finely poised, waiting for a catalyst to move decisively higher or lower. And the potential sources of that catalyst are numerous, including the war in Ukraine and geopolitics more generally, but also the upcoming corporate earnings reports in April, plus central bank rhetoric and China's COVID outbreak, which is ongoing. And that just names a few of them. Now, April is historically a strong month for equity markets, but given the backdrop, it's unlikely to be a smooth ride, even if it ends up being a positive one. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com, Twitter, moneytothemasses with the number 2, and of course you can contact me via TikTok, Instagram, via our Facebook group as well. And of course, don't forget to subscribe to our YouTube channel.